Alright guys, so a lot of us actually came into cryptocurrencies right now via airdrops. That is, we participated in 1 or 2 airdrops, and these airdrops actually paid us, and essentially we actually jumped into cryptocurrency. But do you know that there are other ways right now that people are actually using to multiply their income like every single day right now, guys? This method right now involves cryptocurrency trading, and in this video I'll be sharing with you guys one of the oldest strategies out there that top traders actually use to multiply their income right now. It's actually called top-down analysis, and anyone can actually use this strategy right now to actually start running their own trade. Now the good thing about this right here is that you don't need to risk any of your money right now, because if you are using Bybit actually gives users like a demo account where they can go ahead to practice their trade, because as you guys know, cryptocurrency trading is actually risky right now. You can actually lose and you can win, right? Especially if you are currently a new beginner, and that is why I would invite you guys to go ahead and get your Bybit account sorted out. Link is in the description. Also guys, I'll be taking you guys, like I said, a step-by-step way on how you can actually run this technical analysis, so that you don't have to actually wait for signals from some of these signal groups right now. You would be able to actually create your own trade, create your own take profit, your own stop loss, and all that stuff, guys. All you need to do is just to basically master this strategy, and you should be good to go. Remember, always do your own research, because this is in no way financial advice. Every single thing right here is just for educational purpose and all. So with that being said, let's just jump right into the video, and let me show you guys right now how the top-down analysis work and how you can actually do this with your phone or with your laptop whatsoever. Smash the like button and don't forget to subscribe, and let's delve right into it. But real quick guys, before we jump right into it, the first link in the description of the video right now, you're going to see that I currently have one of the cheapest courses out there, guys, that will literally guide you in terms of cryptocurrency trading and a couple of other things right there, meme coins, airdrops, and the rest, right? This is currently the cheapest, because like I said, with less than just $3, you can actually get this course for yourself right now. That being said, without wasting much of your time, let's begin. Alright guys, so back to the video, guys. Back to the video. First things first, let's say you are a complete beginner right now and you actually want to actually start trading, right? You don't know where to actually start from. First things first, you need a demo account, because you don't want to risk your own funds right now. So make sure you use the link in the description to download Bybit right now. This is my own Bybit account, and the reason why I'm actually saying this right here is because Bybit basically gives out free funds right now. This is just like demo funds that you and I can actually use to practice our trades and all. So click on this one that is called demo trading. Once you click on demo trading, it loads you directly to this page, right? And you will see it here. Welcome to demo trading. Start trading with $100,000 demo assets right now, guys. So Bybit is going to actually give you these funds right now to start trading and just testing things out before you go ahead and start using your own money. So click on start trading with 100k demo assets, and automatically you'll notice that these funds will be automatically added to you. You can see we now have about 189,507 USD here. Remember, this is just demo accounts right here. We can't withdraw this money. So once we are here, we can now go ahead to start trading. So just click on this one that is called trade, and then from here on you can now go ahead to start entering trades, your spots, your futures, and all that stuff. Now that being said, since I've covered that, I'm just going to go straight directly to my laptop right now so that I can explain to you guys fully how this very strategy that I'm about to share with you guys right now works step by step. Alright guys, so on my laptop screen right now, I want you to go ahead and search for the keyword TradingView right now. This is basically a platform that users can actually use to basically monitor trades right now and basically just get a bird's eye view of what is currently going on the space right now. So once you're on TradingView, I'll go ahead and head on directly to the chart section. I'm currently on the chart section right now of TradingView, and if I click on this very button right here, you'll notice that I can actually look up any pair right now, guys. I can actually choose to look up forex pairs, I can choose to look up stock pairs right now, but for this video's purpose, we're going to be looking at crypto pairs right now. You can look up Shiba Inu whatsoever right now, but for the purpose of this video, we're going to be trading BTC USD, guys. Just go ahead and search on it, and it's going to load you up directly to this page. So this is basically the chart right now. Don't get confused. I'm sure that most people right now, when they actually see this, they start getting scared and all. So I want to break things down right now, guys. Right, so we are going to be talking about the strategy called the top-down analysis, and how does this analysis actually work? How does this very trading system actually works right now? There are 3 things we are going to be looking out for. We are going to be looking out for the higher time frame, the middle time frame, and then the lower time frame, right? So for the purpose of this video, my own higher time frame, if you look up this screen right now, you're going to see certain numbers here like 1 minute, 3 minutes, 5 minutes, 10 minutes, 1 hour, 4 hours, daily time frame, weekly time frame, and even the monthly time frame right here. So for the purpose of this video, we're going to be using just 3 time frames right here, right? We're going to be looking at the daily time frame, we are also going to be looking at the 4 hours time frame, and we are going to be looking at the 1 hour time frame right here. So bear that in mind. If you're actually taking notes, actually write this down right now so that you don't get confused. So for our first time frame, which is the higher time frame, we'll be naming it bias, and we're going to be looking at daily right here, guys. That is the daily time frame, right? Bear that in mind. For the second time frame right here, guys, for the second time frame right now, guys, which is also the middle time frame, we are going to name this one structure, right? And for the structure, we'll be looking at 4 hours time frame. Now don't worry, everything might be looking a little bit confusing right now. Just watch closely and don't skip any single part. Now for the third time frame, guys, which is the lower time frame, we are going to be naming it entry, guys, entry, and we'll be looking at 1 hour right here. So now that we have actually said that, I want to actually go again so that you guys actually understand what we are doing, right? So first things first, I stated that when we actually want to actually run this analysis, there are 3 time frames we will be looking at. We'll be looking at the daily time frame, which is our second time frame, and then we'll be looking at the third time frame right here, guys, which is our 1 hour time frame. So these 3 time frames right here, guys, personally for this very video is what we'll be looking at, right? So obviously the daily is the higher, the 4 hours time frame is the middle time frame, and then the 1 hour time frame is the lower time frame. So let's bear that in mind. Once we have been able to establish that fact right now, the next thing we need to do right now is to start with the first one, which is the first time frame. We are currently under it right now. Just keep it simple right here. Let's start with the daily time frame, which is our first time frame. Now if I zoom this forward right now, you are going to see these candlesticks. These are basically called candlesticks right now, and because we are currently under the daily time frame, every single candlestick right here represents 1 day, right? So if I go ahead and just click on any one, you'll notice right here, guys, that for this very one right here, this very green candlestick I'm on, this was currently Friday 17th 2025, right? So if I go ahead and check up any other candlestick right now, you notice that for this very red one, this was on Thursday 4th of 2025 February, right? So every single candlestick right here simply represents a single day. If I was currently on the 4 hours time frame right now, it means that every single candlesticks here represent 4 hours each, guys, 4 hours interval. So what this simply means right here is that when this candlestick was down, 4 hours later it went down again. The next 4 hours it consolidated, and then the next 4 hours it started coming up again and again and again. So every 4 hours, this is what the market actually did right here. So this is just like an example. I just really want to get that out there. If I was using the 1 hour time frame right here, it means that all of these candlesticks basically represent 1 hour each, guys. So what this simply means right here is that at this point, right, the candlestick was actually red, meaning that the market was down. But in the next 1 hour, it actually got a green candlestick, meaning that it came up. After that, another 1 hour later, it actually pumped up again. It pumped up again and again and again. So every single candlestick here represents 1 hour. That being said, let's go back directly to our first time frame, which is the daily time frame. And remember, guys, that we named our daily time frame bias. In trading terms, what bias basically means right here is that you want to use your eye and look at the charts right here. In your own mind, where do you think this chart would be going at? You can see at some point it was down, it came up again, it went down, it came up again, it went down, it came up again, it went down, now it's up. With your own imagination and with your own eye, where do you think the chart would be going to? Do you think from this point right now it's going to be going downwards? Or do you think from this point it is going to be going upwards right now? What do you think right here? Just bear that in mind. That's like what we call the bias right here. You just want to look at the charts right now and just divide it into 2, right? You can divide it into 2. Once you divide it into 2 right now, guys, your left hand side and your right hand side, right? From the left side, you saw where the chart was coming from, and then from the right side, you see where it is heading to. In your own mind, where do you think it is going to go, right? Do you think it's going to go up? Do you think it's going to come down? Once you have established that, you move on directly to the second time frame. And remember, guys, the second time frame is our 4 hours chart right now, guys. That is our 4 hours time frame. We call this one structure, right? We actually gave it a name, structure. So if I come directly right now to 4 hours, you'll notice that the chart would now basically give you a different shape, a different figure right now, right? So when we are now on this time frame, there are about 3 things we need to actually ask ourselves right now. Remember, the first time frame, we were basically just looking at the charts with our own eyes and then just stating and telling ourselves where we think the chart will be going to. Now we are on the 4 hours time frame, which is the second time frame right now, called structure. There are 3 things right now that we now need to actually look out for, right? Now, first things first, we need to look out for liquidity. Now, what liquidity simply means right now is how readily available a buy or sell is on the market, right? Remember that whenever you see a candlestick that is green, it means that people are basically buying the coin, right? Buying, basically, that's what it means. Now, when you see a candlestick that is red, it means that the coin is actually on a sell note, right? People are basically selling. Now, what liquidity simply means right here is how readily available a buy or a sell is on the market. Now, you need to look out for liquidity. Now, let's check this out. Where can we actually find liquidity right now on this chart instantly? First things first, we can actually find liquidity here, right? I'm just going to draw a quick line directly here. You can also find liquidity on this very note right here. I'll just draw this line. Don't worry, I'll explain that very, very closely. You can find liquidity here also right now, guys. Basically, just draw that line. Also, you can actually find liquidity also on this page. Now, if you notice something clearly right now, you'll notice that whenever a market actually touches liquidity right now, guys, that is whenever the price reaches a draw on liquidity, it always retraces. Now check this out. You notice right here, guys, that this market was currently on a downtrend, but immediately it tapped this point. You'll notice right here, guys, that it bounced back up. Also look at this point right here, guys. We notice that the market was currently on a downtrend. It tapped this point and then retraced back up right here, guys, basically, as you guys can see. If you check up this point also, guys, you notice that the market was currently on the downtrend. Immediately it tapped liquidity right here. It bounced back up right here, guys. It retraced. Now, what this 4 hour time frame basically does right here is that it basically shows you the possible area that the price is going to go down to. Now, check this out. Based on all of our assessments right here, based on all what we have actually seen right here, every single time the price actually touches liquidity, it bounces back up, right? We have actually done a draw on liquidity here. So based on what we have actually said, that whenever we are actually using the 4 hours time frame right here, it could actually show us the possible area that the price is going to go to. What this simply means right here is that now the price is here, it is currently on red. There's a possibility that this price might actually come back directly here to this point, tap this point before it now retraces back up. So most times what people actually do right here is that they tend to go ahead and then place a sell order at this very point right here, because there is a chance right now, guys, that this coin that is already selling right now, that is already going down, might keep on coming down directly to this point before it now retraces back. So obviously when you actually enter a sell here and the coin actually does your way, you basically make money simply by just actually looking at the market here, right? So now that is just like an example right here. Let's bear that in mind. We are currently on the 4 hours time frame. Remember, the first time frame we actually looked at was the buyers, that is the daily time frame right here. We looked at initially where we think that the market might go to. Now we looked at the 4 hours time frame, and under the 4 hours time frame we went ahead to withdraw on liquidity right now, just to give us a bird's eye view of what is currently going on the market. When you do this right now, guys, you can actually see a possibility that price might actually go to a certain point, and from there on you can go ahead and probably enter a trade right now. Now mind you, guys, that there are other things you need to look out for while you are still on the second time frame, right? Second thing you need to look out for while you are still on the second time frame right here is the demand and supply zone right now. What the demand and supply zone right now will do for you is that it's going to tell you if your analysis is kind of like a little bit right? Now, let me explain to you what a supply zone basically means. Now, a supply zone right now is a zone where there is a large and uninterrupted downfall, right? So let me explain to you guys that. If I scroll directly to the right, you'll notice something here, we can actually call this a supply zone because there's an uninterrupted downfall. The price right now at every given 4 hours kept on crashing down the hill right here. So what this simply means right here is that this is basically a good supply zone right here, guys. There was an uninterrupted downfall on the market right here, guys. So we can actually call this a supply zone. And if you look up our initial liquidity draw right here, you'll notice that it is similar to this crash right here, guys, that basically happened, right? Also, coming directly to this part, you'll notice that there was an uninterrupted downtrend right here, guys. All of this candle at every given 4 hours kept on coming down. So we can also go ahead right now and say that this is currently a good supply zone right now, and this is also similar to the liquidity draw that we actually did right now. So we can also say right now, guys, that this is actually correct. Now for demand zone right here, guys, demand zone is basically just like the opposite of what a supply zone is. Remember, a supply zone simply just shows you where there was an uninterrupted crash on the market. For the demand zone right now, guys, there should be a large uninterrupted uptrend, guys. Now let's go ahead and look things up right now to see if we're actually correct. Check this out. There was an uninterrupted uptrend right here, guys, right? This market actually came up. Now if I come also directly to this part, you'll notice right here, guys, that there was currently an uptrend that kept on happening for 4 hours back to back to back to back, right? If I also scroll directly to the right now, you also notice right here that there was also another uptrend that basically happened on this area, guys. You guys can actually see it here. So this simply means right here that we are actually correct. So when we have actually done our analysis like this, guys, remember what we did first things first was that we looked up where the liquidity is, that is where it is coming from and where it is going. We marked it out directly on some of these areas right here, guys. If I scroll directly right now, you also notice we placed our liquidity here. If I scroll directly right now, also you notice that we placed our liquidity also here. When we actually marked out these areas, we established the fact that every single part where we marked out our liquidity, every time price actually touches that point, it actually spiked up, guys. That is, it retraced. You guys can see when this market actually hit this point, the price actually spiked up, right? If I scroll directly to the right also, when this market hit this part, it spiked upwards. If I scroll directly also to this point right now, you'll notice right here, guys, that when this market hit this point, it still spiked upwards. So immediately we actually got this point, the next thing we did was to recognize our supply and our demand zone. And I told you guys right now that supply is basically an area where there is an uninterrupted downtrend on the market. And what this simply does right here is that it tells you whether your liquidity levels right here were basically correct. So we went ahead and we checked it out, and we saw right here that this area is currently a good supply zone, because as you guys can see, on every single 4 hours interval, the coin kept on actually crashing down right here. If you go ahead and look it up also here, you can see this is also a good supply zone. Coins crash down badly. And if you come up here right now, you'll notice also here, when we actually established that fact, we went ahead to look up demand zone also. What demand zone simply means right here is where there was an uninterrupted uptrend, that is where the coins actually started going back upwards. Now you'll notice right here, this coin went upwards here uninterrupted, went upwards here uninterrupted, and also you'll notice right here, guys, the coins also went upward uninterrupted here. So when we actually got all of these metrics right, the final thing right here we will need to do before we can even enter this trade right here is that we need to go ahead and look at the last time frame, that is the third time frame, which is entry. Remember, what entry simply means right here is that you are entering the market, right? Now the third time frame is currently the lower time frame. It is currently 1 hour, right? I'll click on 1 hour time frame, and once I click on 1 hour time frame right here, guys, basically this is how the chart would now be looking like instantly. On this third time frame, you are looking out for candlestick patterns right here, guys. Basically you are looking out for candlestick patterns that suggest that your 4 hours time frame and then your daily time frame was basically correct right now. So as you guys can see, everything looks correct to us, and based on my own analysis right here, I'm actually stipulating that this market right here will keep on going on the downtrend right here, right, until it touches this point. Now if it actually passes this point, it is most likely going to come up directly also to this very point right here, this which is currently our next liquidity draw right here. Because remember, what we actually established is that whenever a coin actually touches the liquidity draw, it retraces back upwards, right? So what I'm actually stipulating and what I'm actually speculating here is that the coin would actually keep on coming back directly to this very point right before it retraces back upwards. So as a trader, what I will be doing right here is that I would be shorting Bitcoin, which is I'll be selling Bitcoin right here, right? And that's basically what this simply means right now. Also, make sure that when you are running your market structure, look up for your higher highs, your higher lows, your lower highs, and then your lower lows right now. I'll explain to you guys what that means. When you actually master how to actually do this right now, it's going to actually, show you where the market would most likely also go to. So all of these are just basically analysis that you basically do right now before you actually buy your coin. That way you're actually avoiding, a lot of risk and all. So what I mean by higher highs and higher lows, let me show you guys something real quick. Now, looking up this coin right here, guys, you can see I can actually call this a higher high, right? Let me just basically bring up this right here. So I can call this a higher high, higher low, higher high. Now, because it has actually gotten to this point, if I bring it back directly here, I can call this a lower low, right? It came up a little bit right here, so I'll call this lower high. Now it came down lower than it was, so I'll call this lower low. It came up back upwards, I'll call this lower high. It came down lower than it was, so I'll call this lower low. Now it came up backwards just a little, so I'll call this lower high. It came down lower than it was again, lower low. Now it blasted off higher than it was, so I'll call this higher high, right? And then from this point it came down just a little lower, so I'll call this higher low. Now it came up higher than it was, so I'll call this higher high. And then right here it came down lower than just a little, so I'll call this a higher low. Now it came back upwards higher than it was, right? So I'll call this higher high. Now from here it starts going downwards, and so on and so forth. Now what this would basically help you to do right now, if you are able to master this, probably in another video I'll basically make a video on how you can actually master this very, very closely, right? But once you're able to basically master your higher highs and your higher lows, it's going to tell you where the market is going to be going to. This is currently a higher high, this is a higher low, this is a higher high. Now because it came down lower than where this was basically at, we'll call this a lower low right now. Now whenever you see a lower low, it is time for you to start shorting the market, because you should definitely know that the market will start going down from where it was. Now check this out, because right here we started from here, higher high, higher low, higher high. Now from this point right here, guys, you guys will basically notice that it went lower than where it started from right here. So we're going to call this point a lower low. Now when something like this happens right here, guys, people start selling off right here, because this is a point right here that lots and lots of traders are actually selling off probably a coin, probably something happened and people start heavily selling it, right? Once you see something like this on the market, people start shorting that coin right here, guys, because most times the market actually goes on the downtrend. If you notice right here, guys, from this time the market went down right here, guys. Basically I will show you another example right now to prove exactly what I am actually saying. Now take note of this before I go directly to another example. Remember, we started off here higher high, higher low, higher high. Now it came down too much, lower than where it started from, and we call this lower low. Now because it came directly right now to this point, it means that there's actually heavy sell pressure on the market. People are actually selling off massively. So it is now time to actually start shorting the market from this point right now. And if you're able to actually short the market from this point down directly here, you should have actually gotten some money for yourself. Now let me show you guys another example. I'll just go ahead and look at a good point right here. Now check this out. Let's start from let's say from this very point, right? The market was currently on the uptrend from here, right? So I'll just draw this line. If you notice, the market was currently on the uptrend. We're going to call from this point right here a higher high, higher low, higher high, because it came up more than where it was before. Higher low, higher high, because it came up higher than where it was before. Now higher low, higher high, because it came up higher than where it was before. Now if you notice right here, guys, there was a heavy downtrend right here. Check this out. There was a heavy downtrend right here, right? Now from this point we can now call it a lower low right now, because it came down lower than where it was. So from this point right here, guys, people would basically start shorting the market, because there's a high chance that the market would basically go down right now. And if you actually notice what happened here, you guys would actually notice that actually the coin actually crashed very massively here, and this happens many times on the market. Now, to prove to you guys that this is not just like a coincidence, I will show you guys another point right here. So let's look at from this point, right? Right, I'll start from here. Let me just pull this out closely. I'll just pull this out. Now check this out. We can call this a higher high from this point, right? I'll call this a higher high. Now from here on, it went down directly right now. Let's do this clearly. From here, it went down directly here to a higher low. It came back up here, higher high, higher low, higher high. Now check this out. It came down lower than where it was, so we can call this a lower low. Now from this point right here, guys, people start shorting the market. So I'll just draw this line right here. Let me quickly draw this line. From this point right here, people start shorting the market because from here to here, there was a large sell pressure on the market. Check this out. There was a large sell pressure on the market right now. So once you see a large sell pressure and once it is now on lower low, people start shorting the market, meaning that you should actually sell that coin. Now, if you had actually sold that coin from this point where you actually noticed a lower low, you would have actually caught a lot of cash for yourself from there up until this point right now. And that's basically how this actually works. Probably in another video, I'll make a full detailed video on how higher highs and lower lows can literally help you out also in your analysis. But this is basically just a bird's eye view of everything. If you have any question whatsoever, just drop it in the comment section. I just really wanted to explain this as a complete beginner right here who doesn't know anything about trading. Obviously, there's more to this right now. Remember, we currently have a crypto course in the description of this very video right now in case you want to go ahead and get that. It is one of the cheapest courses you would actually see online right now. So that being said, if you actually enjoyed this video, please give this video a thumbs up and don't forget to click that subscribe button. It is 100% free. I would see you guys in the very next one.